education-related benefits and what it is of these benefits that may be excluded from income. We're going to look at a number of different ones. We're going to look at scholarships and fellowships. We're going to look at education savings bond programs. We're going to look at Coverdell educational savings accounts. We're going to look at qualified tuition programs and also a 529 ABLE. Those are the 5 different potential items we're going to be looking at. So we start with scholarships and fellowships. A candidate for a degree is able to exclude amounts received as a qualified scholarship or fellowship. And a qualified scholarship or fellowship is any amount that's received for tuition and fees to enroll at or attend an educational institution, and any fees, books, supplies, and equipment required for courses at the educational institution, and amounts used for room and board do not qualify for the exclusion. Now, I'll kind of ruin it here at the beginning and say that as we go through each of these, there's different expenses that qualify. And so this issue about room and board, whether it qualifies or doesn't qualify, is going to be different for each of these. And so that's one of the things that you need to pay attention to, unfortunately, is what are qualified expenses for each of these different education-related items that we're looking at. So a taxpayer needs to include in income the part of any scholarship or fellowship that represents payment for past, present, or future teaching, research, or other services. And this applies even if all candidates for that degree program must perform the services to receive the degree. Okay, and so what it is that you're earning for that scholarship or fellowship needs to be included in income because in a sense that's a wage. Second thing we look at are education savings bond programs. Underneath this education savings bond program, a taxpayer may exclude all or part of the interest that's received on the redemption of qualified U.S. saving bonds during the year if the taxpayer uses that interest to pay for qualified higher educational expenses during that same year. And married taxpayers must file jointly in order to qualify for this exclusion. So what are qualified U.S. savings bonds? Well, it's a Series EE bond issued after 1989 or a Series I bond. The bond must be in the taxpayer's name or jointly held with a spouse, and the taxpayer must be at least 24 years old before the bond's issue date. So these are what the requirements are to have that qualified bond. Now, the qualified expenses for bonds. Again, this is for these savings bonds. Tuition and fees required for a taxpayer and dependents for whom an exemption is claimed to attend an eligible educational institution. Okay, and so that's kind of the start. We'll look at who those eligible educational institutions are in a moment. Qualified expenses include any contribution made to a qualified tuition program or to a Coverdell education savings account. Qualified expenses do not include expenses for books, room and board, or for courses involving sports, games, or hobbies that are not part of a degree or certificate granting program. Okay, so a little bit more narrow in terms of what is a qualified expense. The eligible educational institutions include most public, private, and nonprofit universities, colleges, and vocational schools that are accredited and are eligible to participate in student aid programs run by the Department of Education. And so if it's a known entity, that's going to be an eligible educational institution. Now, there are some reductions of benefits. A taxpayer needs to reduce their qualified higher educational expenses by all of these following that we're going to list here tax-free benefits. The tax-free part of scholarships and fellowships, expenses used to figure the tax-free portion of distributions from a Coverdell ESA, expenses used to figure the tax-free part of distributions from a qualified tuition program, any expense used for the American Opportunity and Lifetime Learning Credits, any tax-free payments other than gifts or inheritances received for educational expenses, and these are veterans' educational assistance benefits, qualified tuition reductions, and employer-provided educational assistance. And so a number of ways there that's going to be reduced. Now, what we're interested in ultimately is the amount that is excludable. But if the total proceeds, the interest and the principal from the qualified U.S. savings bond redeemed during the year are not more than the adjusted qualified higher education expenses for the year, the taxpayer is able to exclude all of the interest. Okay? As long as you have more expenses or qualified expenses than you have interest, then the interest is able to be excluded. If the proceeds are more than the expenses, only part of the interest is able to be excluded. And to determine the amount to exclude, we divide all the qualified expenses by the total bond proceeds and then multiply that by the amount of the bond interest. So to determine what it is that is able to be excluded. Now, just to make this all more fun and exciting for us, this interest exclusion is also phased out. It's phased out at different levels of a modified adjusted gross income. And we see here the phase out range if we're married filing jointly, if we're single head of household or qualifying widower. And we remember if we're married, we need to be filing jointly in order to qualify for this. So there is no married filing separately item here. But these are the phase out ranges. Again, you don't need to memorize these phase out ranges. They're going to change each year. But this is where we just need to remember that it is phased out. And we'll go through an example here that has the numbers. In 2020, Robert cashes in his Series EE bonds to pay for his son's tuition at the University of Central Florida. The amount redeemed includes $2,000 principal and $4,000 of interest. Robert is married. He files jointly with his spouse and has modified an AGI of $130,000. Now, the problem for Robert is that this modified AGI is in the phase-out range, but it's below the upper end of the range, and so it's not entirely phased out. So we need to find out how much is phased out. We determine the difference between his modified AGI and the upper limit of the range. And so that was $23,550, $130,000 of modified AGI. The upper range for married filing jointly is $153,550. So there's $23,550 above his level of income before the phase out is lost. So we determine the relationship and to the size of the phase out range. The phase out range is $30,000. And so we divide the $23,550 into the $30,000 and we get 78.5%. So we multiply the interest, the amount that we had in interest of $400 by that 0.785, and $314 of the interest is able to be excluded. Now, it's a lot of work there for the $314 exclusion, but this is how the math works in terms of getting that exclusion and the amount when we have these phase out if it's not entirely phased out. Now, we're going to turn our attention away from our savings bonds and we're going to start looking at Coverdell and qualified tuition programs, but we've got kind of the same qualified education expenses for both of these, and so we'll look at these here at the beginning and then we'll go and look at the details of the Coverdell and the qualified tuition program. So for the purposes of our Coverdell ESA and the qualified tuition programs, our qualified education expenses are amounts paid for tuition fees, books, supplies, and equipment required for enrollment or attendance at an eligible educational institution. They also include the reasonable costs of room and board for a designated beneficiary who is at least a half-time student. Now, the cost of room and board is qualified education expenses for ESAs and the qualified tuition programs, but not a qualified expense for the Education Savings Bond Program, education credits, scholarships, or fellowships. And so, as I said, that room and board is treated differently. So our third item, Coverdell Education Savings Accounts, or ESAs. This is a trust or a custodial account that's created or organized in the U.S. only for paying the qualified educational expenses of the designated beneficiary of the account. And while there is no tax deduction for contributions, the earnings are tax deferred. Okay, we're going to exclude distributions from a Coverdell ESA from income up to the amount of qualified education expenses for the year. There's some adjustments for other benefits received, but contributions are limited to $2,000 per beneficiary, and there are also income limits, and the $2,000 exclusion is phased out. Okay, we need to understand what's happening there with the Coverdell. For a qualified tuition program, this is also known as a 529 plan. This is a program that's set up to allow the taxpayer to either prepay or contribute to an account that's established for paying a student's qualified higher education expenses at that eligible education institution. Now, these are set up by a state agency, an instrumentality of a state, or an eligible educational institution who's able to set up these qualified tuition programs. Now, the benefits of this, the part of a distribution that's representing the amount paid or contributed to it is not included in income. So this is a return of the investment in the program. The earnings accumulate tax-free while they're in the account, and the designated beneficiary, who's generally the student for whom this qualified tuition program is intended to provide, benefits from this. And the taxpayer can change the designated beneficiary, and there are no income restrictions on the individual contributors, the people that are contributing to this qualified tuition plan. Now, there are some limitations to this. The Tax Cuts and Jobs Act consolidated some of these and made new rules. It modifies Section 529 plans to allow these plans to distribute not more than $10,000 of qualified education expenses for tuition incurred during the taxable year in connection with the role or attendance of the designated beneficiary at a public, private, or religious elementary or secondary school. This limitation applies on a per-student basis. It's not a per-account basis. And any excess distributions over the $10,000 received would be treated as a taxable distribution. So we've got a $10,000 limit for public, private, or religious elementary or secondary schools that this beneficiary is attending. Now, the last item that we need to look at is a 529 ABLE. This is an Achieving a Better Life Experience account, 529 ABLE or 529A, and it provides a tax-favored savings program intended to benefit disabled individuals. This is similar to a traditional 529 plan that's established and maintained by a state or an agency or an instrumentality of that state. So these are the different educational benefits that may be able to be excluded when we're calculating our gross income. We looked at 5 different kind of categories: scholarships and fellowships, education savings bonds, Coverdell ESAs, qualified tuition program, and a 529 ABLE. And basically we need to understand what is a qualified expense for each of these, what it is that the money is able to be used for in order for it to be excluded from our income as the taxpayer or for the beneficiary, depending on who it is that we're looking at for this. But a lot of opportunities here for some of these benefits to be tax beneficial to everybody involved, and it's just a matter of making certain we understand the details and what it is that's a qualified educational expense under each of these different programs.